It's a brand new week, and what can we expect from the metals? We have Gary Wagner up next. Gary Wagner starts us off this week. Gary, thanks for being with us.
My pleasure as always.
Gary, last time we spoke, we were looking at how gold was trading in this tight range of 1265 and 1300. You were saying how it would really need to break through that 1300 level, hold resistance, find it at 1339. It did just that. So are we seeing a relief rally, or is this the beginning of something longer term?
Well, you know, as a technician, we're always kind of looking at what happened prior to predict what's going to happen in the future. And more, the technical evidence is stacking in favor of the fact that we've got a real rally developing here ever since we hit those lows at 1185. I spoke about the fact that 1300 was a critical point, both in terms of a technical basis and psychologically. The century marks are always like that. When it broke through 1300, we saw it really run dramatically, to a high of almost 1350. The fact that it's come down and corrected a little bit, I believe Friday's intraday low was about 1180, and recouped so quickly, to me bodes well for the technical evidence pointing to a sustained rally.
We had Vince Lanci on last week, Gary, who pointed out about the formation of a V-shaped bottom. Are you seeing this as well on your charts, and is this a concern for you?
Well, it could definitely unfold like that. Vince is a very, very knowledgeable technician. My take on it, although, is a little bit different. The way that I was looking at it is when the market ran the last run, which I believe was 1203 to about 1350, when it retraced or came back down, it came back down exactly 23% in terms of the retracement. So it falls in line with a corrective pattern within a bullish run. So my take on it is, as long as we're holding above 1300, there's a couple of key numbers that we'll talk about in the insert, but I am not as bearish as Vince is right now.
Also, Gary, this week we have Wednesday's FOMC meeting. Do you think that we can expect volatility? I know you think the rally will be sustained, but do you think we'll have some bumps along the way?
Well, you know, I think that they should term it the roller coaster ride. Anytime you have an FOMC meeting, you've got the facts, and then you've got how the analysts take apart what's been said. And really, as I talked about last week, the Fed hasn't really changed their policy. The words that they've used have subtly changed, but they're clearly on record as saying that it is employment that's the most important number that they're looking at, one, and two, that nothing's etched in stone. They will begin to taper or expand depending on how the numbers come out. So it's obviously, we don't know what's going to happen, but the one thing that I believe is almost certain when these meetings come out is an increase in volatility, regardless of the data that comes out.
Let's get to your insert now. Gary, what have you brought to us this week?
Yeah, today's insert is going to be talking about this break above 1300. Now, I want to look at the smaller details of a chart, going to some what's called intraday analysis, using 180 and 240 minute charts to show that even within a defined rally, it's going to have peaks and valleys. And the market technician really has the ability, when they use certain models, to kind of forecast different peaks and valleys where they should arrive, so that we can increase our success by using timing or strategies to enter and exit at the proper time.
All right, Gary, let's get right to it.
On the last edition of Chart This, we talked about the fact that 1300 was a pretty critical area. We really needed to see the market go above that, and we talked about a couple of levels of resistance, one at 39, specifically 1339. On today's show, what I wanted to do was discuss the techniques that we use to forecast, and also how you can use them both on a macro and micro level. And when we look at this weekly chart here, let's go ahead and blow it up. As this marketplace obviously came down, we looked for a bottom in a couple of places. The first place was a 50% retracement, but the market obviously broke down. The next place that we really looked for any kind of a bottom was at 61%. But that's not enough. So the techniques that we use, the technical Triad, is a combination of Japanese candlesticks, Fibonacci, and Elliott wave. What we look to do is to, in essence, combined these three to filter off of each other. We hit our top here at 1800. As we were going into this bear count, we were looking for a final conclusion and the C wave. A C wave typically will be a series of 5 waves. And so what we did is we counted out 1, 2, 3, 4, 5, but most importantly, it also matched with a Fibonacci number. And then thirdly, we looked to identify the candlestick pattern. Now, in a straight piercing line, it's first defined after a downtrend. You get a long red candle. Then you get the marketplace opening below but closing at or above the midpoint of the prior candle. Now, as you can see, the reason I'm calling it a variation is you had 2 weeks in which the market closed lower, meaning these red candles. But on the third week, you can see it opens about at the point of this long red candle here and closes definitely above the midpoint. It's actually a buy signal as long as the following week is confirmed. Green candle with a higher high and a higher low than the previous candle. Those 3 technical indicators, meaning Elliott wave, Fibonacci, and candlesticks, when we combined them all together, gave us a triple filtering system that told us we had a high probability that we were looking at the bottom of a market. Now, just as we used this technique, a triple filtering technique, in a macro sense, we also use them in a micro sense. This is a 240-minute chart. I'm going to go ahead and pull that up for us. Here is what we were looking at. Based upon the assumption that what we saw when the market hit this bottom at about 1181, our sense was that we had re-entered what's called an impulse phase. And so, as you can see, I've added a count in here where we have 1, 2, 3, and 4. And I want to basically show you how we combine these techniques. First of all, once you have wave 1 in place, becomes really your benchmark wave, and you're going to use this for your assessment in terms of movement of waves 3 and 5. Basic model states that the conclusion of wave 3 should be a roughly 161% extension of wave 1. As you can see, what we've done here is we have put in our extension. We basically looked at the bottom of the market here in the top, extended it from the bottom of 2, and as you can see, 161% takes us literally to around 47, or the top of this market, it comes out at 46. That gave us an indication that wave 3 had concluded and we needed to look for the marketplace itself to begin to retrace. We use Fibonacci retracement, and we put up a couple of levels of this particular move. In other words, the move of wave 3 fell to a 23% retracement level and then began to move up. So we take into account the next part of our model, which states that wave B is going to be anywhere between 50 and 75% that of wave A. So you can see that the marketplace itself actually came right up to the top to the 75% level and then began to come down. Now, as it came back down, there were a couple of things that we could see. And the first thing that we are looking at is how it reacts at 23%. And you can see how it literally bounced off of that level right in here and began to move up. So what are we looking for? If we get a continuation of this upside move, the basic tenet is that wave 1 and wave 5 are going to be about equal in length. So we'll create the model for that to look at where the top should be. If in fact it starts to move down again, it tells us the C wave hasn't concluded, and the next logical step to look for it to go to is about 1300. The key is that by combining candlesticks, Elliott wave, and Fibonacci, it really gives you concrete models to work with. It is my hope that by presenting this strategy and technique to you, it will allow you to become a more successful investor and trader. For those that are looking for additional insight and want to read the article itself where I first published the technical triad, please simply go to our site, thegoldforecast.com, scroll down to the bottom, and you'll see a copyright, this right here. Simply click that, and that will take you to the Kitco bonus content page where there will be additional video and a link in which you can download the technical triad report. Again, Fibonacci, Elliott wave, and candlesticks.
Gary, thank you so much. If readers and viewers want to reach out to you, where can you be contacted?
Everyone can always just email me at gary@thegoldforecast1word.com.
Gary, thanks for your thoughts, and thank you for watching this week's edition of Chart This. You can email us at newsfeedback@kitco.com or follow me on Twitter at Daniela Cambone. Thanks for watching.